In this video, I'm going to go over the Airtasker IPO and the financials behind the stock, so you can better understand the potential value behind this company. Now, real briefly, I'm not a financial advisor and I'm not recommending you to buy, sell, or do anything with this stock. So don't take it as financial advice. It's just for education and entertainment purposes only. Now, before I dive into the financials of the company, I just want to go over briefly the technicals of this stock. It opened up at $1, hit a low of 88 cents, and hit a peak of $1.96. Now, the pre-IPO, the issue price was 65 cents, and there was about 420 million shares on issue. That gives it a market cap of 252 million at 65 cents, and a peak value of just over $800 million at $1.96. So keep that in mind when we go over the financials. Now, before I dive into the financials, I just want to give a brief analogy to the association, or rather the disassociation between some companies' valuation, like actual intrinsic value, and its share price, which determines its market capitalization. Think of it like a pile, like thousands of pens on your desk. The vast majority are going to be shit tier pens, right? They're going to be garbage, plastic, running out of ink, and sometimes those shitty pens just do some capital raising to increase their ink a little bit, just so they can last a little bit longer before you toss them in the bin and they delist. And then occasionally you pull out a Parker pen. This sort of represents your ASX 100 stocks. They're of good quality, they're nice to write with, they always have ink, and they're probably coated in a little bit of gold. They're just really fucking good pens. So Airtasker is not quite the bottom of the pile 10-cent pens. It's probably more somewhere in the 40-cent range. You've got an upper tier shit pen. That's kind of what I think of Airtasker. And people convince themselves that this little shitty 40-cent pen with a little bit of ink inside of it is going to become this glorious $100 Parker pen. Right? That's the story that effectively what you see on the charts here, people are buying into. The idea that this 40-cent pen could potentially be something of value. So that's going to be up to you to decide whether you think it's got any value. I personally think it's absolute bullshit. But let's go into the financials. Now, this is the half-year consolidated financial statements for 31st December 2020. It is the latest financial document that there is. So let's go over the basics. Revenue. This is an increase from 3 mil from the previous half year. So keep in mind, these aren't full year. These are half year. So this is half two of 2019 versus half two of 2020. So we have a pretty good increase of about 30% in terms of revenue. And we end up with some expenses and a total loss of 2 mil, which is an improvement from a loss of 7 mil. So we have an improvement in that respect. We scroll down to the more important data figures, and we have equity. Now, this is going to be interesting. Equity is assets minus liabilities. So things you have versus things you owe, sort of. Now, we have cash of 14 mil in the bank effectively. We have total, let's just look at the total assets. We have 21 mil. We have some intangibles, so that includes things like their software, right, that they run on the phone and on the computer. So that's the value of their software. And we end up with a total asset value of $21 million compared to the previous asset value of 19 mil. We scroll down and we see that there is some liabilities that are increasing, trade liabilities, which is fine, lease liabilities also fine. So nothing here really stands out except financial instruments. So that's 25 mil. This is kind of marginally decreased. And let's have a look at the notes for 10 and 14 to understand what financial instruments actually means as a form of liability. So if we scroll down to section 10, here we are. We have preference share financial liability. Now, to me, I usually don't see this in financial documentation, so let's have a brief look at the definition of what that is as a liability. Now, since I haven't seen it before, I just had a quick brief look at it. Effectively, in this section here and this example, what we have is preference shares are typically issued as a means of raising capital without diluting the voting power of ordinary shareholders. So to compensate for the loss of voting power, the shares will often have preferred rights over ordinary shares, such as like fixed dividend or redemption rights, as well as the preference on liquidation. So That's effectively what that is. I mean, whether this is mandatory dividend payments, I'm not entirely sure how they've structured their preference shares, but it's worth noting that effectively it comes as a form of liability. So we scroll back up to the financial statement. And we take a look and we can see that they're running at a total liability of $35 million. A little bit over 35.5. So in terms of total equity, we're running at negative $13 million in equity. Most micro-cap stocks aren't in negative equity. I mean, the ones that I've looked through, they don't really sit in the negatives. So this is kind of interesting. I don't actually recall the last time I saw a company in a deficiency in equity. So keep that in mind. When you're paying 800 million market cap, which is about $1.90, about $1.90 for 800 mil market cap, that you're paying that price to have negative 13 mil equity, which is a marginal improvement from the negative 14 mil the year before. Let's scroll down. That's to do with share issues. We scroll down here to the consolidated statement of cash flows. Now this is where I saw on, I think it was on ABC, the Airtasker IPO, I think it was the CEO was talking about being cash flow positive, which honestly is kind of an improvement for most of these tech stocks. Most of them don't IPO in cash flow positive territory. So let's have a look. We have the receipts minus the payments and supplies. So revenue minus COGS, which is cost of goods sold, and you end up in cash flow positive territory, plus some interest as well. And then we have payments for intangibles. Effectively, we end up with a position of about $14 million in cash. Also a marginal improvement from the 12 million. Now, having a look at this information, right, having a look at this financial statement, looking at its negative 13 mil equity, it's got 40 mil cash in the bank, plus they raised, almost a couple of $100 million from the pre-IPO. It's hard to look at this and say that this is an 800 million market cap company, right? Going over what we just did with the financials, and I guess one could look at this and go to the equity section. If we go back to here, negative 13 mil. This is probably going to add on about 170 mil on top, roughly, which I believe that's how much they raised. Whatever the amount they raised, if we add it on top, they'd probably be sitting at maybe 160 million in equity, because now they have a cash injection from the capital raising. So we have a company that's 160 million in equity, and almost all of that is purely cash, right? If we just take that into consideration. How much is this company really worth to you? What value do you see in the company that you would pay 500 million market cap, 600 mil, 800 mil, right? There really isn't an association between the value of this business. Like, I'm talking the intrinsic value. We're looking at the cash flow statements. We're looking at the financial situation of the business. There's no real association between that position and the current share price, which is sitting at, what's that, $1.43, and that represents what? So roughly 420 mil in shares times 1.43. We're looking at about 600 million market cap. So with everything we just saw from the financial view, my question to you would be, do you see this being worth $600 million? Now, keep in mind that the current share price doesn't necessarily reflect the current situation of the business, right? This is purely speculation on what the business could be worth. Now, as I understood from the CEO seeing his interview on ABC some other day, they're looking at expanding internationally. So one can look at their current situation where they're barely making several $million in terms of positive cash flow. Is that going to turn from positive 5 mil roughly per half year from PCP? Is that really going to increase to maybe 20 mil per half year, 40 mil, 70 mil? And what's the time frame for that to look like? right? If this company had exponential growth, if we look at something like Afterpay, and I do keep referencing Afterpay because it's one of those stocks that everyone thinks is garbage based on the financial situation, but then you look at the growth of like 100% on every single metric, and it kind of makes sense why it went to $80. Probably not 160, but 80 kind of makes sense. So the question here is, do you see the Airtasker as a company increasing its revenues, increasing its profitability, its cash flows? Do you see it increasing in such a way that it's going to be worth $600 million in the near term? So that's typically what people do when they invest in a stock, is they look 2 to 3 years into the future. So is it worth 600 million today? Well, no, because people don't really, or at least I don't think so. It certainly doesn't appear to be worth 600 million today. But in 2 to 3 years' time, do you see it being worth $600 million? That's the question you got to ask yourself. I personally don't think so, but that's just my own opinion. You're welcome to form your own, and do tell me what you think of the business. And do keep in mind, the market capitalization is not a reflection of the business for today, but its potential in the future. Hence the speculation behind the share price movements. So leave a comment below. I'd be real curious on what you think about the business, its value, and its potential growth. And also, if you haven't already, hit the like and sub button. I'd appreciate that very much. Thanks, guys.